Our webinar will begin momentarily. Hello and welcome to Untangling the Complexity of International Outbound Activities. Before our webinar begins today, I would like to go over a few housekeeping items. If you do not know, you can earn one CPE credit by attending our presentation today. To receive the credit, you must stay connected to the webcast for the entire presentation and participate by responding to at least our interactive questions. You will receive an email within 2 to 5 business days with instructions on how to access your CPE certificate. Please note the questions do not stay on the screen for very long, so please make your selections as quickly as possible. We also invite you to complete the course evaluation that will occur at the end of the webinar. We appreciate any feedback that you can give us. I will now pass it over to our panelists, Mitchell Weiss and Jacob Trevick. Over to you, gentlemen.
Well, hi everybody. This is Mitch Weiss. Nice to meet you. Good afternoon. We're going to be covering two webinars, one today and then one probably next month sometimes. Jake Trevick and I will be presenting on both those webinars. And so the main topic that we'll be discussing in both of these seminars deals with, from a U.S. standpoint, international tax issues associated with cross-border partnership activities. So, as you all probably know, the United States treats U.S. taxpayers, very differently from foreign taxpayers. So, U.S. taxpayers are, subject to tax in the United States under worldwide income. That's subject to, a couple important exceptions. But, and the United States, treats foreign taxpayers, quite differently. So, foreign, taxpayers are only subject to U.S. tax on income that's, effectively connected with their U.S. trade or business, or, to the extent it doesn't fall within that ECI taxing regime and its U.S. source, it's quite likely it'll be subject to, a 30% gross basis tax that could be reduced under a applicable tax treaty. And so, just given this, kind of great divide within the, international tax provisions of our code, it's important when you're doing, research projects to really keep that distinction in mind. And the international, tax treatise that's on the CCH Answer Connect platform. If you go into it, you drill down into that international tax treatise, you'll see that we have an entire volume of material that's devoted just to outbound international tax issues, and then we have a separate volume of material that's devoted just to inbound international tax activities. And so I think it's a real important way of doing research, and as far as I know, it's the only international tax treatise in the market that's actually organized that way. So I encourage you to check it out, and hopefully it helps with your your international tax research. Along the same lines, Jake and I have organized our two webinars around this great divide within the international tax field. So today, we're going to be talking about just from an outbound perspective, certain U.S. international tax issues that come into play when you're dealing with international partnerships. So now we'll go to the agenda here. So how we're going to cover, just kind of organize this, rather than us kind of trolling on with international rules, we thought it would resonate a lot better, just to go through some case studies, a couple examples. So that's kind of how we organized the presentation today. So we have essentially like from cradle to grave, time permitting. We're first going to start with formation issues and some issues that come up when U.S. persons are forming partnerships with transfer built-in gain property. Then we're going to move into operational issues, in particular a fact pattern hypothetical that deals with special allocations of foreign tax credits among partners. And then time permitting, we're going to get into some exit issues where a partnership disposes of stock in a foreign subsidiary and how that affects the U.S. partners of that partnership. you, partnerships are obviously, quite important in international business transactions. You see them all the time come up, cross-border planning. And I think the reason for that is it's really twofold. First, as we all know, partnerships are not tax-paying entities for federal income tax purposes. So, all the income gain, losses, also foreign tax credits, for instance, flow up at the partner level, and then it's taken care of, at that level. And so it's important, with a startup, joint venture, for instance, where, if the joint venture was housed in a corporate vehicle, the losses, those startup losses would, you wouldn't be able to access them and use them against the partner's other income, subject to various limitations. And I think the other reason why partnerships are so, prevalent in the international tax space is because, they're exceptionally flexible vehicles. Again, unlike, corporations, you don't have to allocate the income on a pro rata basis among the owners of a partnership as you would, typically with a with a corporation. But rather you could specially allocate, various partnership items. So we're gonna just kind of give an example of that later on in the presentation today, dealing with how the safe harbor under the 704B regs works when you're specially allocating foreign tax credits. And now I think so. We'll just start off with the first kind of portion of the presentation, which is formations. So you can obviously form a partnership with cash, but oftentimes what investors do is they'll take built-in gain property and use that as the consideration in exchange for the the ownership interest in the partnership. And again, there just like the corporate sub-C rule, section 351 or 368, we have our Subchapter K corollary set forth in section 721A, which is provides for non-recognition treatment as a generalization. When you transfer built-in gain properties to a partnership, unlike a 351, there's no control requirements. You don't have to have 80% of the transferee. Just any sort of contribution of built-in gain property is going to be, in the first instance, eligible for non-recognition treatment under 721A. But like everything, all general rules in the tax code have way more exceptions than there are general rules, and that's usually where all the action is. And there's no exception here. There are a lot of exceptions to the general rule of non-recognition under 721A. And most of these exceptions apply regardless of whether the partnership is engaged in international activities or not. So you could have an exception that would shut down non-recognition treatment in a domestic context. It would do the same thing in an international partnership sort of context. So just to give you a very quick example of that, if you were to contribute built-in gain property to the partnership, and within, say, 2 years, you were to receive a distribution from that partnership, there's disguised sale rules under the 707 regs that would say, since the distribution was within a 2-year period of when the contribution of the built-in gain property was made to the partnership, that's going to be presumed to be a disguised sale of that property rather than a tax-free rollover of it. So that's one exception that applies across the board, whether it's international or not. What we're gonna focus on is a provision that only deals sort of in the international partnership context, and that's section 721C. That was enacted in 1997. It replaced an excise tax regime under the former section 1491 provisions of the code, but it was enacted in 1997, and it's not a self-executing provision. So it was just really lying in wait in the code, just waiting to leap up and shut down non-recognition transactions. But it needed to be implemented through regulations, and so it was just on the books, but it didn't have any real meaning behind it until 2015. There was a notice that came out, and then the final regs were ultimately issued, I think, in January of 2020. And so those regs kind of flesh out really the provision here, and so we're gonna just go through an example that kind of illustrates what those requirements are. So with that, I'll turn it over to Jake, and we'll go over the first problem.
Great, thanks, Mitch. So in this scenario we're going to look at, we have a foreign partnership, and it has two corporate owners. It's going to have G Corp, which is our U.S. corporate partner, and it's going to have FZ Corp, which is our foreign corporate partner. Initially, it's 20/80, with 20% going to our U.S. partner. But G Corp makes a contribution, a built-in gain patent, to a partnership in exchange to increase its stake up to 40%. So the question that's posed is, do we get 721 non-recognition here? Well, so preliminarily, you have a contribution to a partnership, so that would preliminarily get you into 721. But as Mitch pointed out, we have this 721C regime, a regulatory regime, that we have to consider. So the very first thing is, do we have to go through a multi-part test. One, do we have 80% control of the partnership? Well, looking at here, the contributing partner has 40% interest. So I guess we think we probably flunk, and we don't have to go through the rest of the exercise. Well, obviously not, right? Because FZ and G Corp have that 100% shareholder relationship. So they're going to be related parties under I think the 267B rules. And so we're going to look at that together and find that we have related parties controlling the entirety of the partnership. So we're still in 721C branch. Then we go to the next question. Do we have the shifting of a potential item of gain from a U.S. partner to a foreign partner? Absolutely, right? Where initially G Corp has 100% of that patent that they put the built-in gain. After the contribution, 60% of that gain would be allocable, generally speaking, to FZ Corp, the foreign partner. So we're still in this acceleration regime. The next question is have we contributed an item that excluded property, something that carved out a 721C? So what would that look like? That'd be cash. That'd be some tangible gain property with limited gain, and it would be a stock in a company, securities. Well, no. We have built-in gain property, and it's a patent. So we are absolutely inside the 721C acceleration regime, and so preliminarily, we would lose non-recognition. Okay, is there any way that we can avoid it? Well, yeah. So 721C allows the contributing partner to elect into the remedial allocation regime as a way to avoid this immediate recognition. So what does that mean? It means that income or gains related to the patent is going to have to be preferentially allocated to catch that gain to the partnership. It means that we're going to have to extend the statute of limitations on our initial non-recognition. This is probably kind of reminiscent. It's, in the C context, this probably sounds a lot like GRA type math you might be thinking about. It's sort of an analogous concept here. And again, analogous again to GRA, if we have a disposition, we have to think about potential acceleration of that gain. There are exceptions, but you have to elect into that regime. Do we care if partnership is foreign or domestic? Well, not really, because while for other purposes, and we'll get there, we do care about that foreign domestic partnership question, the 721C acceleration question really rests on if we are transferring gain to a foreign partner. So it's really more about what our other partners are as opposed to what the partnership itself is, or the locus of that partnership. So in this case, it actually doesn't really matter between domestic and foreign. So now we've gone into 721C gain deferral. I think I'm going to pass it back to Mitch for this part.
Cool. Okay, so yeah, 721C is designed to ensure that certain built-in gain property is not shifted through a partnership structure to a related foreign partner, and that would be the case here if you didn't opt into the gain deferral method. And so as Jake had mentioned, the gain deferral method generally requires that you adopt the remedial allocation method, and then all of the sharing ratios with respect to your 721C property, use the same sharing ratios. And then, you extend the statute of limitations or extended reporting requirements. and so forth. One thing though I should mention is you don't have to opt into the remedial allocation method or have consistent sharing ratios if the property that's contributed to the partnership is throwing off effectively connected income, because then in that case the foreign partner is going to be subject to U.S. tax on its share of that gain. So it's sort of a fork in the road in terms of how you apply the gain deferral method. So let's just assume they adopt the gain deferral method, and now we're in a safe zone. We have non-recognition treatment under 721A, but we're still subject to this gain deferral method, which one of the requirements is that if there's any sort of acceleration event, then the remaining pre-contribution built-in gain needs to be recognized by that contributing partner. And so the question is, in this slide here is, what happens if D Corp receives a distribution, from FPship, from partnership, and that distribution exceeds D Corp's outside basis by $100,000. So, under Section 731A, D Corp recognizes a $100,000 gain. Is that going to be treated also as an acceleration event, and in which case you'd have to recognize, the remaining, pre-contribution built-in gain of the patent? And so the first scenario here is we're assuming that there's no 754 election in place at the partnership level, and in that event, that's not going to be treated as an acceleration event, because acceleration events are defined in the regs as very broadly as anything that reduces or could defer the built-in gain in the patent. Okay, and so if there's no 754 election in place, you still have a carryover basis of that patent at the partnership level. So you haven't reduced that built-in gain, and there's nothing that happened here that would have deferred the timing of when D Corp recognizes the difference between the fair market value and the basis of the property that was contributed. So assuming there's no 754 election in place here, that would not be a triggering event under the gain deferral method. But now, okay, so now we go to the second part. Okay, well, that was easy enough. Now what would happen if there actually is a 754 election in place in the partnership? And so in that event, what's going to happen is the partnership is going to step up the basis of its assets by the amount of the $100,000 gain that D Corp recognized on that distribution in excess of its outside basis. And so a portion of that $100,000 is going to increase the basis of the patent. You'd have to go through the mechanics of 755 to determine exactly the amount of that and so forth. But the reality is you've now increased the basis of the patent as a result of the 754/734 mechanics here. And by increasing the basis, even partially, of the patent, what you've done is you've reduced the built-in gain that is supposed to be preserved under the gain deferral method. And so on its face, that constitutes an acceleration event. And the question is does that make sense here? And the answer is it does not make any sense. And in fact, there's an exception to that being an acceleration event in the regulations. And what the regs say here is that in the first instance you've reduced the inside gain on that patent, and so that's a triggering event, that's an acceleration event. But and so what would happen is D Corp would have to recognize gains to the extent of that increase in the basis of the patent. But the regs go on to say that gain that D Corp has to recognize, the gain being the amount that the basis is stepped up at the partnership level as a result of the 754 election, is reduced not below zero by the amount of the gain that D Corp recognized on this distribution that gave rise to the step up at the partnership level. So D Corp here, recognized $100,000, and that $100,000 of outside gain is going to, inevitably is going to exceed, or at best, it's going to equal the amount of the basis step up in the patent at the partnership level, and therefore the exception to this being a partial acceleration event under the regs applies. And so in this case, there would not be an acceleration event, but if you flip it and you had FZ receive a distribution in excess of FZ's outside basis, and it resulted in a step up of that asset, that would be an acceleration event to D Corp. So just because D Corp already essentially paid for that step up in its outside gain recognition. But if you flip the analysis here, and it was FZ that received the excess distribution, that would be an acceleration of that. And so D Corp would have to pick up the gains to the extent that that basis step up on the patent. So a lot there, but let's move on.
Absolutely. So and a lot more of this detail, like with target, is I think in chapter 13.10, I believe, in the treatise. So that's where you can pick up a lot of these exceptions to the exception.
So chapter 13 in the international treatise covers all the outbound international partnership issues, and then I think it's chapter 23 covers the inbound international partnership issues. So if you wanted to dig into that treatise there.
Sure. So let's change the facts a little bit here. So we've done our initial contribution, but instead of the built-in gain patent, we have built-in gain shares in a foreign corporation. So again, we go through our 721C mechanics. We have the related person. We have the shift in value. We have the built-in gain. So do we still have to worry about 721C? Well, in this case, it's actually a little different because stock in a corporation is going to be an excluded property item. So we're actually out of the regime. So we're just we get this is actually we can do. There might be other considerations about for more in the C context, but it's not going to be not imposed by
one thing in the C context, and sometimes you get good planning ideas just from the Treasury's preamble on recognizing issues that they say they're still considering but haven't shut down, and that one of them is here. They said we're considering whether or not we should expand the scope of the gain deferral method to take into account CFC stock that you transfer, but that's not the case currently. So there could be some planning opportunities.
And it's worth noting that even in this version, FC kind of remains a CFC here, right? Because we have the attribution.
Sure.
This might have at one point looked like a DCFC transaction, but not anymore, right? Okay, so I think this is our first polling question. So which of I'll read it out. Which of the following types of property are going to be subject to 721C regulations? So I think we covered this a bit. This cash equivalent, stock in a domestic corporation, stock in a CFC, or a patent with a $1 million built-in gain. So I guess we give that a moment.
Yeah, I'm not sure how this works. You just pick your answer online.
I think.
Back to you, gentlemen.
Awesome, thank you. Appreciate that. Hold on. Great. So the answer there is going to be that patent with the built-in gain, right? Just because everything else is going to be within the definition of excluded property. But built-in gain IP is definitely squarely within the sights of the 721C reg.
If I just mention one thing on 721C, it's when you put in a built-in gain property, and then that property is sold by the partnership, it no matter what point in time that's sold, Section 704C is going to allocate that gain back to the contributing partner, and so that's why 721C seemed like it wasn't really necessary until about 10 years ago. There was a lot of IP migration projects that a lot of the firms were working on, Jake and I included, and so what you would do there is you would adopt the traditional method, and you would drop it in, and then you would maybe wait 7 years and distribute the built-in gain property to the non-contributing partner. So it was a way of sort of outbounding IP and avoiding the 704C constraints that's always been in the code since 1954. So they needed to sort of tighten things up, and that's the essence of why 721C sort of came into existence starting in 2015.
Okay, so for the next section, we're talking about special allocations, and specifically for our scenario here, it's going to be special allocations of foreign tax.
So, as I mentioned earlier, partnerships are incredibly flexible creatures of tax law, and so you're not bound by any sort of pro rata allocations, but rather, subject to limitations in the 704B regs in particular, 909 as well. You could specially allocate various partnership items, and that's going to be respected, for tax purposes. So, time to get into all that, but that raises the question of whether you can also do that, with respect to, foreign tax credits. The regs, in one part of the regs, it says that, the special allocation of tax credits just does not have substantial economic effect. And that actually makes sense because with tax credits generally, that doesn't affect the capital account. So the economic effect test is not, it doesn't accommodate the allocation of tax credits. And so, the allocation of tax credits, foreign taxes as well, is based on the general sort of, partner's interest in the partnership concept, which is, just sort of a facts and circumstances, look at the overall economics of the situation, make sure that the tax is not driving the economic dog's tail. So, given that it doesn't have substantial economic effect, you don't want to rely on this sort of amorphous, partner's interest in the partnership concept. The regs, I think going back to maybe around 2006 or so, or early 2000s, have promulgated a safe harbor in the regulations. And so if you comply with those regulations, even though the allocation of the foreign tax is not going to have substantial economic effect, it will be deemed to be in accordance with the partner's interest in the partnership. And so that's what these regs get at. Good. So what's the essence of these reg requirements? So there's really two overall requirements, and the second one has three components that are listed on the slide. So the first one is that the partnership allocations, that relate to the taxes are valid. So as long as all of the allocations that are in some way related to the foreign taxes are valid from a 704B standpoint, you've satisfied the first one. And then the second one, the second requirement is that the foreign taxes are allocated based on the income to which they relate. And so the regs here, the guts of the regs kind of drills down into that, and it gives you these three requirements here. So there's a three-step process. First, you have to determine what categories of activities the taxes relate. And a category of an activity of a partnership, it's not a foreign tax credit branch concept. It's really about the economic activities of the partnership. If you have a disregarded entity and it has a different sort of sharing ratio of its items relative to other disregarded entities of the partnership, that disregarded entity would be treated as a category. So it's sort of a factual analysis to break it out into economic sort of categories of the partnership. Once you do that, you need to make sure that the income, the net income within that category is based on U.S. tax principles. And then the partnership needs to allocate and apportion the foreign taxes. You have to determine what is the base upon which the foreign taxes relate. And so you say, okay, well, this tax relates to this income. Well, what income category is that? And then the taxes need to be shared based on the same income that's in that category. And so obviously, as I said earlier, it's easier, I think, to go through some scenarios. So we'll get into the example here and kind of flesh that out.
Sure. So to illustrate the point, what we're going to have is a U.S. partnership, this BP partnership, which is equally held by two U.S. people, Emily and Rosie. And the partnership has one flow of income, and it's like a Brazilian active business. They are 50-50 partners in the business, so all the income, the general items are flowing up 50-50, but Rosie has other losses, significant foreign source losses, and so they want to allocate foreign income taxes away from Rosie. So sort of straightforward why they want to do this, right? The foreign taxes, Rosie's probably not going to be able to credit those, right? Those losses are going to reduce her foreign source income, which will reduce her foreign tax credit limitation, and presumably, even with this Brazilian foreign source income coming in, there's going to be some deadweight loss, and the credits will get locked up in a carryover account, and who knows? Maybe we'll never get to use it, or it'll take a while. So they wanted to do this disproportionate allocation. So is that going to be respected? Well, we go through our test that Mitch laid out, right? Does this have substantial economic effect? Well, pretty obviously, no, because you've done a different income tax allocation than you have for general items. So the next question, are you within the safe harbor, right? Well, we're go through the process determining income items on a U.S. tax base, determining foreign taxes, allocate between categories. Well, here we only have one category. So this example could have been different if there were sort of more operations inside that DP partnership, and which might have given you some availability to allocate Brazilian income to Emily and non-Brazilian income to Rosie, but that's not really available here. So we have 50-50 allocation of one category of income. Well, the taxes have to follow the income. We're obviously not doing that, so we're not going to respect this. Now, the question is, are we okay if we allocate it equally? Well, yeah, because that does follow the income. That's what we're supposed to do. We're meant to put the foreign taxes in the same proportion as you have that category of income. So yeah, that's not what you can do. Basically, what you have to do in this scenario.
Right. Just a couple points on that. So you notice at the outset here, this allocation was tax motivated. There's no, there's nothing more than just sort of tax motivated situation here. The regs don't get into motivation. If you satisfy the safe harbor, you're fine. And so unfortunately, they didn't satisfy it here. And just one more point on the category. So I don't know if I mentioned this, but the category, the category has to have a different sharing ratio than any other category. And so Brazil, the same sharing ratio of the income of Brazil all in. And so all of that branch income, let's call it, of the partnership in Brazil is treated as one category. And that category's income, the income in that category is allocated 50-50. So the taxes, and that income forms the base upon which the taxes were incurred.
Right.
And so the taxes then need to be allocated on the same basis as the income in that single category. So the taxes needed to, I might have been given away, been allocated on a 50-50 basis. So
right.
It wasn't, and therefore it flunks the safe harbor. And then you would ask yourself, well, okay, I flunked the safe harbor. Is it possible I could still rely on the partner's interest in the partnership, just the general sort of facts and circumstances? You can, but the preamble says that it's exceedingly rare when you do that. And so for practical purposes, all you really have is a safe harbor.
Especially in this case where there's only one item, and
totally.
These facts are really not amenable. You can't. I would struggle to come up with a version or reason why this would be that circumstances respected.
Same there.
So next question is, and this is part and parcel of whenever you have tax come through a partnership, you consider, do we have a splitter? Do we have a tax splitter? Now, I don't think we got into it so much in this scenario, but when you're looking at allocation of taxes, Section 909, which I think was put in 2010, was brought in to attack structures where the taxpayer was separating income from taxes. It actually gives you I think 4 enumerated scenarios that are going to be split. And it's important to know it's a suspended regime, so you have to wait. It's not that you lose the credit; it's that you can't include the tax credit until you include the associated income. So the main thing to keep an eye on, that you know that you have to start pulling your 909 regs together, is do you have a reverse hybrid in the system? That's like a red flag. So if we have income being accrued inside the reverse hybrid and taxes being accrued, being paid above it in the partnership, that is very likely and very potentially going to be a 909 splitter. In this case, we don't have that. There's no, it's just a branch operation, so that's not going to be a concern. There is, though, sort of one last 909 type transaction where you might have an inter-branch sale or inter-branch income flow within a partnership or within a structure, and which is creating a local country tax, but the income kind of gets eliminated inside the partnership because you have the deduction of the income item offsetting, so you effectively are popping local tax without having sort of concurrent income item in the U.S. Again, single branch, not really to worry about. So no hybrids, no interbranch transactions. We're outside of 909, and we get to just look at the special allocations on their own.
Yeah, one thing that's confusing about this is it seems, and it is, to some extent redundant with the the safe harbor for especially allocating foreign tax credits under the 704B regs. Really, this was an add-on sort of feature to those regs as it relates to this interbranch payment splitter partnership splitter arrangement. What it is, 909 is it sort of it complements the 704B regime, in that the 704B safe harbor we went through with the categories and so forth, that's a cliff effect. If you don't satisfy it, that's it, and then it's up to facts and circumstances on how you really should be allocating those taxes. With the 909, if you're covered under 909, which this fact pattern is not, it actually, as Jake mentioned, it isolates just the amount of taxes that are split as a result of that interbranch payment, and then it tells you exactly when and how much of the taxes free up when the related income is then is brought back to the person that got too much of the taxes. So it's
Prevention.
Yeah, it is, but it's a mechanical. It quantifies the amount, whereas with the safe harbor and the 704B regs, you don't really know where you're at when you flunk. When you flunk this, you know exactly how much taxes are suspended and how much income needs to be brought to that partner before those taxes are freed up. So they fit like hand in glove here, really.
Yeah.
But in this case, it's not a splitter arrangement, so it's not relevant.
Okay, so I'll hand it off for the next polling question. So going back to our section here, an allocation of credible foreign taxes can never have substantial economic effect. Never. True or false?
Back to you guys.
Thank you. Appreciate it. So this is covered. So we have all these safe harbors. Well, yeah, but this is actually true. It's not that you're having a substantial effect. You don't have substantial economic effect if you do a special allocation. It's just that you flunk substantial economic effect, but can get to the safe harbor for your disproportionate for your special allocation. So it's a little tricky there, but
it's a trick question. The allocation is valid, but it's not valid because you satisfy the substantial economic effect test. It's valid because you satisfy the safe harbor for the PIP.
Yeah, basically, it's a savings clause, basically. So now we're on to partnership-owned controlled foreign corporation.
Yeah. Okay. So there's some new developments here. We don't have an example on this, but I think earlier this year they finalized the regulations, and so now for Subpart F income purposes, domestic partnerships are truly schizophrenic entities, meaning that for determining, whether a foreign corporation that's owned by a domestic partnership, whether that foreign corporation is a CFC, you apply an entity theory, meaning you look to the actual shareholder, that being a domestic partnership, to determine whether you exceed the 50% vote to give rise to CFC status. But then for the income imputation requirements, you treat that domestic partnership as a foreign partnership, and so it's an aggregate. So that's what I mean by sort of a schizophrenic view of domestic partnerships. The situs, domestic or foreign of a partnership, matters sometimes, not, maybe 10% of the time it actually matters, and the rest it doesn't. But we're gonna get into one where it does. So we're gonna talk about disposition issues here with respect to CFC stock, the partnership cells.
Okay, so here's our last scenario of the day, and we have this foreign corporation, FX Corp, that's held by a domestic partnership, which in turn has two partners. One is a domestic corporate partner, and the other is a U.S. individual, Taeyang. They're unrelated, so we respect that 5%, 95% split. They've held it for 5 years. There is untaxed E&P accumulated at FX Corp of 100,000. They're going to sell it for 150,000 gain. So we have U.S. domestic partnership with a foreign corp with $100,000 of E&P and 100,000 gain on the sale. So what is the amount of the character of the sale? Well, so the first question we look at is we see FX Corp is a CFC. Why are they a CFC? Because the domestic partnership, in this case, for this purpose, is considered to be an entity. So that is a 958A shareholder. That is the U.S. partnership, and so when they sell it, they will be selling a wholly owned CFC. And then, as you know, when you sell a CFC, you have to think about your 1248 character, because in principle, preliminarily, I should say, we have $150,000 of capital gain, but 1248 is going to recharacterize, to the extent of the untaxed E&P, a dividend. So that can be 100,000. So we're going to have 100,000 of dividend and then 50,000 of residual capital gain. Now, it kind of produces an interesting result here, because the dividend is good for the USP corporation, because they are going to be able to treat it as a foreign source dividend, which nowadays is going to give you 245 Cap A, generally. Taeyang is not eligible for 245 Cap A because they aren't a 10% U.S. corporate shareholder. So they just have capital gain. But because it's held by the domestic partnership, the 1248 recharacterization is determined there. So whatever 2/3 of their gain is going to get recharacterized as a dividend, which frankly might be bad for Taeyang, because it's not straightforward that that's going to get the preferential dividend rate. So it's potential that this is actually an adverse result for Taeyang when she sells out, because she'll have a recharacterization of a dividend that's probably going to get taxed at the ordinary rate. Do we care if this partnership is outside the U.S.? Well, Taeyang sure cares, because if this is a foreign partnership, we are no longer have that as a U.S. shareholder. FX Corp is definitely still a CFC because it has a 95% U.S. shareholder, but Taeyang's interest isn't a U.S. shareholder under that 10% voter value rule, right? So she's not. So USP Corp is going to make that sale. They'll have a 1248 event. To the extent of their share of the EMP, they're going to get a dividend recharacterization. They are going to get the 245 Cap A. Taeyang is not going to be a 1248 shareholder in this fact pattern. And so when she sells out, she just has capital gain. It doesn't have to think about dividend income results. So we sort of don't have perfectly aligned incentives here between our partners. So I think we kind of answered the second question as well here. I guess the one interesting part to mention on the 245 Cap A is the transferor here, the one that initiates the gain, is the partnership. And generally speaking, you would be looking at the dividend for classification. You'd want to have the dividend being paid like directly to a U.S. corp. But this has actually been clarified that we're going to treat USP Corp as getting the dividend from a 245 Cap A perspective.
Yeah, there's just a couple points on this. So, you have 245 Cap A, and that only applies when you get a dividend, right? So when a U.S. corp that is a U.S. shareholder of a foreign corp receives a dividend, then you go to 245 Cap A, and assuming you meet this, 365-day holding period over a 720-day time period, you get that hybrid issue, so forth. You get the 100% dividend received deduction. There's the corollary provision in 1248J, which it accomplishes the same things. If you didn't have the similar rule where you get a DRD on a portion of the gain that's recharacterized as dividend under 1248, if you didn't have that, that would just be a trap for the unwary, because you could have just distributed out the earnings, got the DRD, then sold the stock. You shouldn't be in a worse spot if you just sold the stock that had the untaxed earnings and profit. So that's why 1248J was enacted as part of the TCJA. But it creates some problems here because some ambiguities. Not terrible, but if you look at the face of the provision, you have to have a U.S. corporate partner owning more than 10% sell the stock. And so that would only be the case here if you view it as an aggregate, the partnership. The partnership's one selling. But the legislative history makes it pretty clear that they wanted to extend it through partnership structures, and so it's pretty clear that there would be a DRD that would flow through based on USP's profits interest in the dividend, the recharacterized dividend component of the partnership. So
right. Okay, so this is our last polling question of the day, and again, we're going into this question of which of the following taxpayers are going to be eligible for 245 Cap A DRD. It's going to be a U.S. citizen, a domestic corporation, an S corp, or a foreign partnership which is owned by foreign individuals.
Okay, gentlemen.
Okay. Thank you. Well, just want to say thank you for giving us your time. We appreciate the opportunity to walk through these issues with you. Pass it along to Kevin for the Answer Connect.
Thank you, Mitch. Thank Jake. Great content here. I'm going to see if I can my screen to share. Can you guys give me a thumbs up or let me know that CCH Answer Connect is on the screen?
We can see it.
Excellent, excellent. So yeah, I'm going to take the last couple of minutes here to just talk a little bit about the text research platform, CCH Answer Connect, that we've made available a few years ago. I know Mitch made reference to it a couple times, but as we developed this platform, we really wanted to focus on presenting content in a digestible manner that equates out to the tax research workflow that we observed in all of our customers using our platforms, and really wanted to be able to allow the research to be conducted regardless of levels of experience. We've dealt with some extremely complex issues here today, but we want to really boil down how we can get to it from a topical discussion of the overriding issues and boil it down and really get directed into the code sections related to the areas in which we need to do the research. Again, doing a lot of this in terms of focusing on that research workflow and the process by which you pull all the information together, as opposed to in past platforms where you would go into a code section or an explanation, and there would be made references to all sorts of different areas within the platform's codes, regs. We heard a lot of talk about the regulations and the changes to those and the interpretive guidance that they grant as part of the overall research process. Again, we wanted to streamline that process. So for today's example, we are actually going to run a really quick search here on credible foreign tax expenditures. I'm actually going to use some of the intuitive knowledge here from CCH Answer Connect and run that search on that specific topic. And again, as we go through this, just kind of think about the process by which you would use this kind of information. So we're going to go into this topic page, which is going to give us a high-level overview of the process of the discussion itself. So as we walk through, curated by one of our individual legal editors here, it's going to go through, give you this overview of the specific area, the qualifying taxes, any additional information you may need here, determining whether a tax is a foreign income tax, all those different pieces you'll need to walk through as you familiarize yourself with this topic. We'll have comments, practitioner notes, examples, all as we flow through this topic page. I'm going to use my navigation bar here, and again, kind of looking at this from a tax research workflow. I'm going to jump down further on this page. You'll notice I haven't actually left this location, but this is all the recommended topics that our editorial team wants to make you aware of as a researcher that you may also need to dive deeper into. You need to deal with any direct foreign tax credit issues, indirect foreign tax credit issues. Are there any limitations? If there are any accounting issues that you need to address. So again, all of that content has been brought to you directly. What we've also done from an editorial standpoint under our key primary resource is now bring to you as the researcher all the related code sections tied into this specific topic. We heard mention of code section 909 here. It's one of the listed. There are several other code sections made reference to from this topic page that may also be of interest as you go through the process. What we've also done is brought our smart charts and our practice aids to the forefront. As a researcher, you're able to then take advantage of these practice tools to better communicate or to assist in communicating what your findings are to either a client or up the corporate ladder, as the case might be. And as we scroll down, there's again some news that we put out here, pubs, foreigns, and finally we do end up with some additional CPE. So if you want to go into some additional professional development, if you do need CPE credit for certifications, you have the ability to do that directly from this topic to increase the amount of the learning that you're doing. I'm going to scroll back up really quickly here and go into my key primary source, go into code section 909 as was referenced during the presentation earlier. What you'll notice here is that we've put together and accumulated all the relative information for code section 909 on a single screen. Again, in the past, you would have to go from your code section, click on a link into a regulation, which would take you into a different database, and then into the explanations if you're looking for any of the guidance, additional databases that you'll have to go through. So we've actually aggregated this information in its entirety on a single screen. So if we work from left to right, you've got your code section. From here, we're able to go in and take a look at all of the regulations related to 909. Jumping further as we again move from left to right in that process workflow, moving into the CCH explanations that are interpretive guidance regarding this specific topic. Then, as a researcher, do you need to get into that cases, the administrative guidance, the rulings, the annotations? That information would dwell here as well. What we've also enabled you to do as a researcher, and I know Jake and Mitch mentioned this several times, is where you get into the subsections within the code. We also give that ability here within CCH Answer Connect. So if you, for example, need to go into the special rules under 909, you have the ability to get that information specifically. If there's definitions, you'll have that information here as well. Again, just allowing the researcher to get to the content they're looking for in a more streamlined fashion. going to go back to my topic page here really quickly and go back into my search results, because I did want to point out, since Mitch and Jake were so gracious to give us the time to give us these presentations here, I'm going to hop over to my international tab. And I believe one of the references they made was in chapter 13 in the outbound transactions under the partnership piece. This is the information also included within the search results that will take the researcher directly into the treatise prepared by them and give you that information, that additional guidance that they've used and talked about so much today, chapter 13 being the outbound related to partnerships. Again, just the ability to gather all of that content, all of that information from a single search. It was one of the primary reasons that CCH Answer Connect was created. We would love the opportunity to discuss with that further, and I believe our final polling question will give you the opportunity to make that request directly to Wolters Kluwer. We can get your sales rep in contact with you and just give you a trial and let you take a look at CCH Answer Connect. And with that, Sharon, why don't you pop up the final polling question?
Absolutely, Kevin. And thank you for that excellent demonstration of CCH Answer Connect, and a thank you to our panelists, Mitchell and Jacob, for an informative presentation today. This will be the final polling question. Would you like a more in-depth demonstration or further details on the resources and tools available in CCH Answer Connect? I'll just let you finish doing that. The question will remain up as we wrap up today's event. The webinar will conclude once this polling question is completed. As a reminder, there will also be a few quick survey questions for you to complete following the conclusion of the presentation. For anyone who answered at least 3 of the required polling questions and stayed connected for the entire webcast, you can expect to receive an email within 2 to 5 business days with instructions on how to access your CPE certificate. Please note, the instructions will be sent to the email that you used to enroll in today's event. Thank you all for attending Untangling the Complexities of International Outbound Activities. We will leave that question up for another 30 seconds. And this concludes our webinar today, and we'll see you next time.